First and foremost, welcome to the TIE's first webinar, Yield to Pedestrian. This topic is going to be focused on the erosion of some of the large APYs that we saw in the last DeFi cycle and where we are headed in terms of a steady state moving forward. But I'll start us off with a quick disclosure, and then we'll go ahead and introduce our panelists and then kick off. But appreciate everyone tuning in. So thanks for joining. The information contained in this webinar is for informational purposes only and should not be considered as investment advice. Joining us today, we have three panelists, Cosmo Jiang, Lili Wang, and Josh Lim. I'll go ahead and let each of you go around and take a second to introduce yourself.
Awesome. Thanks for having us, Jack. So my name is Cosmo. I currently serve as head of strategy at Skolem, which helps institutions access DeFi. I'm also the founder of Nova River, which is a digital assets hedge fund. I've been investing in crypto since early 17 and joined Skolem earlier this year to help that project grow. Prior to this, I spent over a decade in TradFi and banking and private equity at an equity long short hedge fund.
I can go next. My name is Lili Wang. I am a general partner at QIS. We are a AI-driven quant fund in crypto. I've been building and investing in the space through multiple cycles now. And my background is in TradFi, in trading and banking as well. And been investing in everything from real estate to crypto to equities, emerging markets, multi-decades. So it's really nice to be here. Excited about this panel.
Hey everyone, my name is Joshua Lim. I'm the head of derivatives at Genesis Trading. Genesis is a large dealing desk in crypto. We do everything from sort of spot and derivatives trading, as well as sort of lending and financing and custody. I've been in the space since 2014 in various sort of sell side kind of seats, providing kind of services and products to a lot of the institutional investors who are getting access to the space. Part of that, I used to trade equity derivatives in traditional finance.
Awesome, and thanks for joining everyone. I'm Jack. In case you don't know me, I work on the research team here at the TIE. But I guess without further ado, we can start kicking off. A good place to start, I think, would be one of these topics that's really top of mind over the last few weeks. There's obviously been a lot of contagion, a lot of liquidations, a lot of leverage getting unwound between Terra, QIS Capital, Celsius, and the list kind of goes on from there. Josh, given your seat in the derivatives market and given the way that you're trading on a daily basis, I'm really curious, as a starting point, how much of this leverage do you think is actually worked out of the system? How much more unwinding kind of remains to be seen and isn't even disclosed yet? I know Sam from FTX said that he thought a lot of it was unwound, but curious what you're seeing on your side.
Yeah, I think, if anything, the last couple of weeks have sort of uncovered what an extensive sort of shadow banking network there has evolved to be in crypto, right? So there's clearly, this is the first cycle that we've seen in crypto that has been fueled by a large sort of credit component. I think when we think about our business at Genesis, a lot of it has been sort of secured lending or collateralized lending. But there's obviously a large component that has come into the market that's been undersecured or unsecured. And a lot of that sort of lending and that credit came from the sort of retail platforms that were taking sort of customer deposits and then lending those on to market makers and liquidity providers and hedge funds. So, I think what we've seen on our side has been pretty extensive deleveraging in the last couple of weeks, where, the firms that have retail exposures have largely been forced to kind of disclose when they have to halt withdrawals because of the issues with the loans that they've made to institutional counterparties on the other side. For the most part, I think the obvious sort of issues have been sussed out there. I think there's probably more where the deposit base has been relatively sticky, and maybe there's some that won't have an issue there for a while. maybe never. And then on the institutional side, I think a lot of it's been worked out, and is pretty much in the open at this point. I think for a long time, even kind of post the Terra incident, like a lot of people were sort of rethinking how to manage credit exposures in their book, how to sort of like put on sort of credit and macro credit hedges across the counterparty exposures that they did have. So I mean, we certainly did, and I think a lot of other counterparties did as well. So I think from like a directional exposure perspective, a lot of that has been worked out. In fact, I think we've seen a lot of people sort of come in and, especially on certain types of resolution in the market, where you see kind of good headlines or potential sort of bailouts happening. We've seen a lot of people come in to sort of like unwind those hedges, whether they be in kind of derivative format or just buying back spot that they had previously shorted. So we think that a lot of it's worked through, on at least on the crypto kind of idiosyncratic side of things. And what remains to be seen is sort of what happens in the macro, kind of the broader macro risk asset world, right? So that's what we're pretty sensitive to in terms of thinking about how capital allocators are deciding to sort of rotate back into crypto. And I think that sort of comes at the later stages, right, of sort of other risk assets stabilizing and people sort of neutralizing their equity exposure and things like that, and then sort of turning back into crypto to get more upside.
You did all that without saying the word contagion. That was our keyword. Everybody's supposed to drink if somebody said that.
Yeah, Josh is elite at that. But Lili and Cosmo, given a more kind of fundamental long-term view, as we're thinking, a lot of this asset exposure within CeFi was really through kind of repackaging of DeFi products to retail, right? And a participant actually sent this question, and I thought it was a really good one, is how do these earn functions on CeFi evolve for the next stage in terms of, on one hand, the regulatory kind of responsibility of presenting non-vetted products to an unsophisticated audience, but also in terms of like, how do you actually set up fundamental ways for that to be sustainable and not self-destroying as a business?
I mean, that's a lot to unpack there. But if you start from looking at the way TradFi manages through that process, whenever you're offering investment advice or products to investors, because of the SEC, CFTC, or whoever you're regulated under, you need to have a reasonable belief that they're sophisticated enough to understand the products they're getting into. A lot of times you see that's accredited or QP type of status. And also you need to have licenses to show that you know what you're doing, like 0xB1. You have to show that you actually know what you're doing in the products you're offering. Now, this gets really tricky with CDeFi, as you said, oxymoron in its name, right? Like when you have essentially DeFi storefronts facing retail or facing the meat space, and you're saying, hey, I'm offering these yields, but with a lot of hand waving obfuscation of where these yields actually come from. The products themselves that you're offering are unregulated. We don't know if they're currencies. We don't know if they're commodities or securities. So there's no way to adjudicate any kind of fraud or bad behavior. To your investors, their funds are unsecured and they don't take prioritization, and they're not preferred in the position of the company. And so you're getting into this mess where you are creating a carry trade, but you're raising money in a way that is unregulated. You are essentially a carry trade hedge fund trading in random thingies that are not regulated, right? And so you can see that when things go wrong, they go wrong really, really fast. And today, I think ZipMex, which is an exchange, just gated as well. And that's the only response. Let me stop and figure this out, which then creates a lot of negative sentiment. And that actually leads to run on banks, right? Because they themselves don't know what's going on. And when you're centralized, right, and when you offer these storefronts, typically when things go wrong, you might gate, but then there is a process. But now we're in a situation where there is no process, there's no adjudication, there's no clarity on the legality surrounding these things. And so that's why we have this kind of domino effect, right? And so I'm actually on the side of, I think regulation would be good for clarity in the system. It might cause certain pains and it might be counter zeitgeist. but in the long term, it would allow institutions to come and play, and it would allow people that are skilled in the space to really offer the products in a risk-adjusted way. But I'm an optimist, so.
Yeah, I think I'd echo a lot of Lili's thoughts. Look, it's very clear that these CeFi institutions, I mean, the dirty secret was they did deal in unregulated but unregulated securities, and yet marketed themselves as safe platform for customers. And it's really the latter part that I think is the problem. And you know, not to say that people necessarily had ill will or meant to do wrong, but the fact is that we need to be, as much as it is nice that DeFi has enabled consumers to make their own decisions and put the power in the hands of the consumers, this incident has proven that to some extent, you know, consumers don't read the fine print. And so like there is some level of regulation and some level of consumer protection that is warranted, especially if they are marketing themselves as safe institutions. And so, you know, I think like, unclear whether these CeFi institutions' business models were sustainable before, or whether they were evolving to have more sustainable sources of unit economics on customer deposits. And we'll likely see them move towards that way, regardless of, we will see them move towards that way. But in addition to that, I would expect, and I do hope for more regulation and just more clarity around the marketing rules around this, so that customers are protected when this happens.
Yeah, no, I think both you guys struck the nail on the head. And a big part of it is also going to be getting clarity and structure around the DeFi products themselves, right? In terms of as an investor in traditional markets, you know, like a stock is a stock is a stock, right? And the debt obligation is generally a debt obligation. But in crypto, you don't actually know what is necessarily underlying that token that you're buying. What entitlement do you have to cash flows? What entitlement do you have to debt positions, if any, right? And this is actually going to probably force me to say one of our other buzzwords, which was RWA, right? And thinking about what is going to be the impact of bringing in RWAs in terms of allowing investors to have access to yield, but without necessarily having exposure to DeFi exclusive yield, right? Like, are you only being exposed to activity within decentralized markets, or are you actually like bringing in off-chain capital via smart contract, right? And so when I've been talking to Cosmo, when I've been talking to Lili and Josh about these topics, right, one of the things we've been thinking a lot about is how does yield start to flow back into DeFi in a current environment where we're seeing rising rates, yields on 10-year treasuries are higher than stablecoin yields on chain, which in a risk-adjusted and liquidity-adjusted factor makes no sense, right? So how does the system return to normal, right? Like, how do we get back to a normal state here?
I mean, you also hit on the head something that's interesting, right? Like creating meat space access into DeFi, a lot of it is saying, hey, DeFi is this magical land of lots of yield, right? And I think that's as far as a lot of these platforms got, right? Like, forget about the fact that Voyager actually said there's some kind of like bank like protection FDIC type thing. Like that's just bizarre. But like when you have CeFi saying like let's just take for granted that there's yield, right? And we actually saw one that just raised a pretty big round, offering what, like 4%. Like that is not a given, right? That is not a given that you can beat that carry trade works. But there's always going to be a vacuum for this stuff, because there's always a population that says, hey, we can't touch it, we don't know what it is, but I hear that there's all this magical yield. But, you know, if we talked about, you know, with our Mochi Donut session, was just that a lot of these yields actually only work in contango markets, right? Like a lot of these flywheels, you can make yield by staking, you can make yield by sharing fees, which is transaction volume based. But a lot of that is contango. When markets go up and yields are emission based, that works. When markets are not going up, it stops working, right? And so a lot of that is abstracted away and not discussed by these storefronts, right? These CeFi platforms. And yet people keep flocking to them because people view DeFi as too dangerous or too crazy. And so, yeah, I think it's important to unpack RWA, and I'll stop ranting for now. Real world assets, and I think that was actually that came into the forefront of discussions because MakerDAO has partnered with Huntington Valley Bank, actually saying, "Hey, we're not going to just buy USDC. We're going to put real assets into the system," and that's where RWA came through. But now people are looking at that as a source of yield. Which then makes you wonder what it is about DeFi and the blockchain that could make real world asset yields that much more effective and or safe. And so I think that's, to me, first principles on this whole level.
Yeah, I mean, I would say like, one thing that is an issue with going back to the DeFi, status quo ante is like, there were a lot of conflation issues between like, what is the source of yield, right? Because I think a lot of DeFi, like if you think about things like Anchor and the sort of like much way off market yields coming from there, was that it was coming from sort of like tokenomics or just sort of like endogenous supply that wasn't really resulting from sort of productive use of assets, right? Like you might think of things that are more organic sources of yield as, like things like transaction fees, from mining or from, selling calls, like you're actually, transferring some sort of risk to receive yield, or, from like these real world assets that are paying yields based on, capital allocators deploying capital somewhere for productive use, right? So I think those are sustainable sources of yield, and those are like real, they were reflected in some piece of the sort of overall yield picture before Terra and before 3AC. But I think post that, like there's going to be a much more clear delineation of like what is coming from token incentives versus what is coming from actual yield, actual sort of like credit risk, actual sort of like risk-free rate. The basis trade that Lili is talking about, that's like a sustainable source of yield, and as long as the curve isn't contango, because there's actual demand, you're providing sort of leverage to retail customers who want exposures on leverage, right, on the future. So that's like a natural source of yield that makes sense. But in a world where like all the future curves are flat, and where there's maybe much less speculative demand, and there's maybe less volumes on exchange, so hence there's less sort of demand for from market makers for inventory and things like that. Like what is going to drive sort of yield expansion or yield generation opportunities in the future? So I think that's a big question that's gonna have to be solved by a lot of sort of DeFi platforms, and that's why I think there's a push towards real world assets.
Yeah, I think it's probably helpful to just like a level set and talk about where again, going back to like what it means for status quo. There is no status quo in crypto. Things change very quickly. But certainly the prior status quo of like where all this quote unquote yield was coming from was like, it was, some of it is more sustainable than others, but like the main sources are probably either one, leverage lending fees for people taking leverage and willing to pay for that. The other is market making fees, transaction fees, which like clearly like those exist in the real world, like right now, Citadel, GS, whatever, and collect those, and instead users get to collect those in DeFi. The other is like the big source, and probably the biggest source for a while, was protocol incentive token emissions, right? So essentially stock-based comp, and like other people are getting diluted when they're issuing that. Then there is like the more intrinsic to the risk of the asset, which would be like impermanent loss. So you should deserve some risk premium for impermanent loss if you're participating in certain pools. There's obviously the security risk or the total loss premium for holding something in a smart contract. And then there's the risk-free rate, which like everything should be built on top of that, or each of those sources of yield. And it just so happened that in the past, primarily most of the yield was coming from protocol incentive token emissions, or like, VC fund my life type emissions, right? Which is what Anchor was. And that is going away. That goes away in a bear market. That's very cyclical. But how does that compare to the real world? Like in the real world, yield on bonds or yield on debt comes from cash flows from productive usage, and from a premium to the risk-free rate. And so like the two questions there are, as we try to translate that into DeFi, is like, how can we bring these productive cash flows into DeFi, or can we build more productive use cases for blockchain on the chain? And then two is like the bigger question, which is unanswerable today, is like, what is the reference rate? Like, even as we're talking about yield, like in the real world, like, we talk about yield relative to the US Treasuries, right? Like, what's the risk premium that you're getting for this type of instrument? And right now, it's not very clear what the reference rate, what the risk-free rate is in crypto, especially because it is sort of like a global paradigm, whereas in the US, we only have to think about relative to the US rate. In Europe, you only have to think about it relative to the euro interest rate. Like, because crypto is kind of global, like, what is the right risk-free reference rate? Like, and like right now, we see that on Uniswap and like, or Compound or whatever, like basically for reasonably risk-free stuff, you're getting like 1 to 2%.
0.48 on Aave on USDC.
Right. Yeah. Right. But like, yeah, exactly. Or like even lower. And so like, that's, I mean, that's like maybe, arguably it would suggest that there's too much capital deployed into stable coins, and like we actually should see more outflows to level out with like what the global interest rate is. But.
Yeah. And it's not just on the stable side too, right? Like, if you kind of think of USD or stables as the equivalent of like dollar denominated investors in a global market, then like ETH or Bitcoin denominated investors would be like other currencies, right? And then even if you look at ETH denominated rates, like, it's really broken, right? If you take staking rate, at least post merge, as a risk-free rate for an ETH denominated investor rather than a treasury rate, and then you go to LP and ETH USDC on Uniswap, when you count impermanent loss, smart contract risk, all these other things that we were talking about, deploying capital into an actual blockchain product is actually not even, it's earning you like 7%, which is negligible over staking rate. So why would you be like, how are you incentivized to take on that sort of risk, right? And that's been a big problem in terms of risk pricing on chain right now, and in terms of getting people to actually buy in to these products, because they're not actually compensating people properly for the amount of risk that they're taking on relative to other options in this space.
And I think the hyper liquidity, even the liquidity should be a risk like deduction, but it works in a weird way in crypto, because to your point, Cosmo, like the VC transfers in crypto is a very weird dynamic, because in the real world, you can afford to have negative unit economics and VC transfers until you get to a flywheel size and it's working, and then you IPO, and then through that, you go through Starbucks or whatever regulatory hurdles you have to jump through. But because crypto is so hyper liquid, right? You take a situation like UST and Luna, it's like, well, VC transfers really funded the rate, and they were desperate for people to borrow because that was part of what the reserve was. And the borrow rate, they were paying you to borrow at some point because they were really hoping that thing would work, except people just borrowed and put it right back to the thing that the VCs were supporting. Not to mention the collusive VC exits upon TGE and all of that, which makes like this liquidity profile of crypto really kind of dangerous for retail. But back to your point about rate, I mean, right now, I bonds are 9.6, right? Like inflation adjusted government bonds, everybody should buy some, there's a limit. But the thing is like that, to me, if you look at ETH or Cosmos or like Polkadot or whatever these systems are as emerging markets, the macro risk there is massive, right? So it's like, I'm not seeing double-digit DeFi yields in a risk-free or low risk way, where institutions would say that makes sense. And by the way, there's no regulation around this stuff, and drawdowns can be 90%. Good luck. It's like, what is the incentive, right?
I think that's like the biggest problem with DeFi, and like we've been telling this to everyone that's coming to us for like, can you stick some TVL into our project or whatever. The issue is that like yields in DeFi, because a lot of it is driven by sort of these incentive token incentives, right, are not like set at market rates. Like in TradFi, it's like your yield is proportional to your risk, like the risk that you're taking on something. And DeFi doesn't work that way. Like a lot of things are set by formula, right, or by like supply curve or whatever. And it's maybe you can change it via some governance process, but it's not something that's dynamically adapting to market conditions. So if you have like a big exogenous shock, like like a massive credit crunch in crypto, like those rates are not necessarily adjusting in real time. So like, and like Jack, you brought up this thing about, you know, what are the implied yields in like LPing into DEXs, right? And like that is a particular issue because if you think about, you know, the risk that you're taking there is you know, you're giving up, obviously, well, one, you're basically putting unsecured capital into a project, which means like there's a huge opportunity cost with that capital, which is very expensive right now. Like that is the number one thing you should be compensated for right now. And that, like in centralized markets where you're giving an unsecured loan to a, you know, a very good counterparty, right? Like maybe there's not a lot of those left in crypto these days, but if you were to do it to a very good counterparty right now, who is like able to deploy it into very juicy, like distressed opportunities right now, like you should be getting paid maybe like 30% plus annual for that, right? But that doesn't exist in DeFi right now, right? And then the other thing is like you're giving up some sort of like your short gamma, right? Like there's some risk profile associated with the IL, and like you should in theory be pricing that with like a vol model, right? Like you're basically, you should reflect like the implied vol for, let's say for ETH, like ETH implied vol is like 100 vol, right? So are you getting paid some premium, some option premium for being short that IL? And I don't think most people are thinking about it that way, because if they were, then like the size of the pool should adjust to reflect like the premium that you should be getting paid, right? And with a smaller pool, that means you should be collecting more in transaction fees, right? So like that's how that risk transfer mechanism and pricing mechanism should work, but it doesn't really, because all of DeFi is sort of premised on the fact that like, you know, there are a small subset of the total market participants that are actually good at risk pricing, and the vast majority of people are retail that are just depositing without any sense of like what is fair value. And that's like the biggest problem with DeFi today, I think. I don't know.
Yeah. It also concentrates value in specific tokens, right? Where especially at this point in time, if you want to be deployed in DeFi, you're stuck in a small handful of tokens where you not only trust a Uniswap smart contract, but you also trust that this project isn't going to have some huge failure that's going to destroy you on impermanent loss and cause you to get wrecked in the pool, like regardless of what your other half of the pair does, right?
Yeah. I think this people are probably drinking without even the buzzwords by now, but I would say that I would like to propose, like if you're looking at RWA in terms of what models work, right? Like there's things in the real world, like trade finance, there's this $3 trillion hole, much of it is insured, right? There's like subprime lending, which is right now like 100 to 160% with 50% charge-offs in the world, right? There's things like payroll, auto, inventory financing, all that stuff. That yield exists. And there are DeFi platforms like the Goldfinches, Maples, the TrueFis, the like Centrifuge. They're trying to get into the space. But I think the issue is, and we saw this with one of these platforms that would try to work with a company that does that is actually tokenizing single family homes and stuff. And they've done a great job as a fintech with this in Web 2. The problem is the point of failure is the collateral and the smart contract. So I would say like DeFi yields could exist if you take these real world yields, which are currently financed by the Fortresses and the Apollos and the Goldmans and all that stuff at around 10 to 12%, put it into DeFi, because it's a lot, the transaction portion, the part in the settlement is easier. And then you tranche that and you might be able to get different yields, right? If you tranche that according to risk in DeFi users will be able to access that. But you need to have, and I'm going to be burned at the stake for this, but you need to have some sort of centralized proven Oracle system in the CeFi world, in the TradFi world. And so instead of looking at mortgages or real estate and stuff, maybe you look at RMBS, or maybe you look at, you know, like consumer lending, and I'm just spitballing, but you would need somebody like a structured products desk at one of these banks, or you would need people in the space who have real world oracles and data, something akin to a Moody's or an S&P to actually port in the oracle into the DeFi world. And right now that's almost heretical, right? You can't have centralized oracles on chain to run smart contracts, like off chain to run smart contracts on chain. And I think that's the point. If somebody can fix that, you would be able to port real world assets into the DeFi world. But then the question is, can you do that in size, right? Can you do that when there's tons of hedge funds and banks that are willing to provide the liquidity quickly and in size? If you could solve those two issues, then DeFi has a shot at real world assets. right? And then that can actually extend out, that opportunity set into developing markets, into people that have less banking access. And that's where you get into the bankless, permissionless world. But those hurdles are big hurdles. And so when people mention like, oh, I'm just going to do like a risk pool that's community sourced, or I'm going to do people that come in, like we're going to do underwrite risk-free assets, like real world assets, like payroll or trading. And then we're going to have communities to underwrite this. That becomes very, very hard. Whenever you have community sourced alpha or risk metrics, it most certainly breaks down. And so I think solving oracles from the TradFi sources and then having some kind of vehicle to port that into DeFi, that would be really interesting for me.
Yeah, I think the real unlock for DeFi is something that you said was earlier, which is that like in the digital trustlessness and the ease of settlement is much better, and that's where we'll find efficiencies relative to like real world underwriting. And then the fact is that in order to really grow credit, we need to grow unsecured credit or unsecured or under collateralized credit. And in order to do that, you do need to bring in credit underwriting and transparency and trust in credit underwriters. And I think certainly at the beginning, we will need to bootstrap and trust like centralized credit underwriters like we do today, like S&P and Moody's. But eventually, hopefully, as like on-chain entities, much like Maple is trying to do with like orthogonals and Mavens of the world, as they build credit underwriting credibility, maybe we can start trusting more crypto native institutions and eventually potentially more decentralized institutions for credit underwriting. But for sure, the issue right now is like the lack of credit underwriting lack of standardized credit underwriting to enable more fair pricing and more fair risk allocation.
Yeah, I mean, it's right now you can make the argument that all of DeFi is equity and we're all pretending it's credit somehow. Term yield is actually misleading to me in a lot of ways.
Yeah, quickly wanted to jump in here and say if anyone in the audience has questions, feel free to submit them now. I'll start throwing them in as we go since we're coming up on 10 minutes left. But given that we've been in the weeds on DeFi for a little bit, it might be good to zoom back out. And one of the things I was really thinking about kind of from a thematic perspective lately is when we look back at the end of 2017, the majority of crypto companies created during that era are barely even discussed anymore. If we go back to 2019 and 2020, some of the DeFi 1.0 stuff is still around, but from a token price perspective, the vast majority of it is still completely crushed from even its peak during the last era, despite the recent bull market. And when I'm thinking about, okay, how am I positioning over the next 1 to 2+ years even from a thematic perspective, and I'm thinking, okay, we're heading into a bear market, but I still want to accumulate digital asset exposure. Is there any point in even going into alts at all? Or am I just buying ETH and Bitcoin, waiting for the next bull, and then deploying capital into the best new projects because current tech won't hold up?
I mean, I think that is a big problem with crypto in general, right? It's just that it's like the pace of innovation makes it very easy to obsolete like older technology. And yeah, like there's not a lot that makes it from one cycle to the next. I mean, like, I think there's a huge problem right now with sort of like the supply overhang and like existing tokens out there, mostly from the way venture investors and founding teams have structured the sort of token supply schedules. So yeah, like I don't think you have really a lot of incentive to go out and start a new liquid token fund and go buy like existing secondary market tokens, right? Like you're probably better off like focusing on newer tech out there at better valuations and lower valuations, right? And then riding that VC wave all the way to liquidity. But yeah, I mean that's a hard problem to solve, and that I guess like other asset classes have solved that differently, right? In equities, there's like there's I mean even in equities, like the way that the liquidity sort of sort of the path to liquidity has changed a lot over time, right? You think about like, used to be like people would go public very early on and retail would be able to participate in the long-term sort of growth of a business. And now it's all kind of going through privates, or like, you know, in the last wave, we saw like a bunch of SPACs happening, right? So I think crypto will continue to sort of evolve and try to figure out like, what is the right way to sort of like build the sort of incentive alignment between like users and early stakeholders and investors, and the project itself. And you know, I think that's an open question. So yeah, it's a good question for sure.
Yeah, I feel like it's such a, so if you look at the actual dynamic of, and this goes back to regulation, right? Imagine if the NASDAQ also owned a venture fund, as well as a hedge fund, as well as a marketing firm, right? As well as a market maker and prime broker all under one roof, and they'd all talk to each other with no walls, right? I'm sure we all know who I'm talking about, but that's basically who you're trading against in crypto. So trying to do the fundamental, oh, what fundamentals, right? It's kind of like, that's why our approach is like, let's look at the price action, look at momentum. That is the single most determining factor. And, you know, as a plug for the TIE, your data's really helped us. But I think, but I think that, you know, I totally agree with Josh. I think there's going to be a lot of green sprouts. You see a lot of new L1s being built, and I think they're being built because the valuations there and VCs need to deploy. But then, you know, also, you know, there's going to be support. So it's like, it's a little bit of a cynical view. I think that looking at things that are very, very derivative, like maybe your aggregators, and God forbid there's any more OMIs out there that are still trying that, or like, you know, even like the vote escrow, vote lock, like a lot of the old playbooks are going to get reinvented. And then I think a lot of the attempts at DeFi native debt, and then whenever I hear DAO tooling that is not charging for valuable service, I get a little bit scared. And so I think for us, you know, as a fund, we're looking at momentum and broadening our universe, investable universe. But for us as builders and investors, I'm actually looking at real step innovations that have real world touch points into crypto, instead of crypto derivatives that are essentially money Legoed. Because frankly, right now, there's so many dev teams moving around. A lot of it is just like, you know, I just don't know how sticky these teams are as they go from one project to a next, hoping to raise and fund themselves for a bit until they can degen into something. And that's very cynical, I know, but that's reality.
Yeah, I'm probably sitting on the other end of the spectrum, where I do believe that a lot of these tokens that are going through the bear market now and the teams are realizing the importance of building sustainability into their corporate structure, into their governance, and eventually allowing these tokens to accrue value and have fair value. And you know, I'm very deeply a fundamental investor who believes that everything will trend towards fundamentals over time. And you know, that's the only way that the crypto industry will grow up, is as more traditional TradFi capital with the fundamental view comes into the space. So if you believe crypto has a future, that's sort of the incremental buyer. And the incremental buyer is talking to these protocols, or I am talking to these protocols and telling them, look, this is what needs to happen for your token to go up effectively, but also like for you to build a sustainable business. And you know, we are seeing governance proposals from Maker and Aave to try to figure out more ways to Lili's point, to bring in productive real world assets or productive cash flows into the system, or to just build governance structures that work better and can be more effective than super decentralized DAOs. And like, you know, you are seeing that some tokens are more clearly, some teams are more clearly trying to allocate value to their token, right? Their recent tokenomics changes to Chainlink, to DYDX, that both suggest that the management teams are very focused on trying to figure out ways to get their tokens to reflect the underlying business fundamentals and accrue those, let that value accrual happen in the token. But that's not to say that, you know, that's not making a broad swath comment on whether all tokens have value, because that's certainly not the case. You know, most tokens do not have value. But some do, and many are changing so that they increasingly do have value.
Yeah, I actually wanted to follow up with you. I was super hoping you'd have that opinion and thought you might, given that you just launched a liquid token fund. But, you know, obviously the majority of tokens don't have value. There are kind of a few thoughts that I have briefly that I wanted to ask you, if you have anything additional or your thoughts on generally what actually makes a token sustainable and has it accrue value fundamentally, right? There are these kind of DeFi native trading protocols that capitalize on people's interest and accrue value like that. And for me, though, one of the things that I really want to see is some sort of fee or revenue pass through so that you can actually gain exposure to the underlying project success. The other thing I think about is what is the yield that you're getting paid out in, like what form is it taking? Are you getting paid out in kind? Is there going to be a ton of sell pressure on the governance token because of that? Or are you getting paid out in ETH or stables or some other asset that you want exposure to, right? The problem, of course, with that being that it opens you up to a whole host of regulatory risks in terms of being potentially considered a security. So how are you kind of balancing that trifecta of like wanting exposure to actual fundamentals and value, but also like not wanting to expose yourself to a ton of other idiosyncratic regulatory risk, et cetera?
Yeah, I think the regulatory front is a fair point. That a lot of the reason why a lot of these governance tokens are quote unquote valueless today and or viewed as valueless today is because they are trying to avoid the potential being accused of being called securities because they're distributing value. I mean, that's why I think regulation is incredibly bullish for this space. Like everyone's trying to make money, right? And like, it's very clear that the management teams that own these tokens want to make money. And like the way to do that is to let your token grow in value over time. Or that's the way to make big money. That's not like you can run away with a scam or a Ponzi quickly, but like the way to really compound your capital and create, in a really bull case, like Amazon level wealth, you need to create value and compound value within your business. And so I think management teams, or the good management teams that I am going out and trying to assess whether they're good management teams, are doing that or trying to do that. In what denomination are these tokens distributing value? That's a great question. I'm personally much more interested in tokens that distribute value in, or that collect revenues or transaction fees denominated in USDC or in ETH. I view those as, well, ETH is obviously a volatile token, but I view those as true non-dilution and based forms of productivity or forms of yield. And to your point, it also reduces selling pressure or potential, flow pressure. Not that that should matter over the long term. But yeah, it's really focusing on tokens where there is a true business case to be found, or where there's like a real belief that they can have sustainable unit economics. It's talking to the management teams and making sure they're on the same page as you and they're sort of rowing in the same direction, that they do want that value to accrue to the token. And yeah, trying to pick the winners where that cash flow is actually sustainable and not just not more volatile.
Awesome. Well, I know we're coming up on 2 minutes and we have a hard stop at 12:45. So I guess I can throw one last question out there for us to touch on quickly. But how much of, and this is going to be a very open-ended question, so like we can keep it to a short answer each, which is going to be really hard, but how much of crypto do you actually think is sustainable right now? In terms of like how much of it doesn't actually need to be funded by outside sources and can truly grow of its own accord?
I don't think it bothers me so much that a lot of these companies, or most of these companies, are not sustainable on their own right. It's not so different from super early stage growth tech investing, which I did a lot of in my prior life. None of those businesses have sustainable economics in this very current moment, but you can see a world as they scale that they can get there. And so I'd say like the answer is near zero for sustainable protocols, maybe outside of like some of the real blue chips that make money, like a Maker or Aave or Compound. But that's okay. Yeah, I'm at peace with that. And I sort of as a long-term bull on the space, you have to believe that that these tokens will scale, or that these protocols will scale and reach that point of sustainable economics. And two, that there will be more and more interesting use cases that don't exist today that do get created, that do end up creating value and creating sustainable unit economic business models.
Yeah, I mean, I would say like, there's broad categories, right? There's like things that could have some monetary premium as a store of value. There's things that could have some, transaction usage as a currency. And then there's a bunch of stuff that is tied to like cash flows, whether they call themselves a security or not, right? Like exchange tokens and things like that. And those are, those are some of the things that I think will be durable investments long term.
Yeah, I would echo all of that. I do think there's another dark horse, and I think that's going to be NFT 2.0s. As real world gets into that with real benefits and real experiences, and I really stress the word real, you're going to see actually more crypto assets enter the system. And I think they're going to be on ramps for a lot more trading activity. And so I want to see more RWA. I want to see more real NFTs in the 2.0 ecosystem. I want to see, and I think it's okay to have zero value in a lot of these DeFi experiments because it's shot pinning for the whole system to see what is fragile and what is sustainable. And it also gives investors like us a purview into the current investor pool mindset, right? Like cult of personality, psyops, a lot of how shilling works. Like when we saw quote unquote DeFi 2.0, you saw the kind of excitement, exuberance. It's very memey, right? And so as I really like the whole term that Cosmo uses of like DeFi growing up. As that grows up, you're going to see different sets of investors come in. You're going to see different demands. And I think right now, DeFi in a lot of ways are solutions looking for problems. But I think you're going to start to see those two things click together more. So I'm excited about the next cycle, but I think the investable universe must expand for anybody looking at the current DeFi landscape.
Amazing answers from everyone. Thank you so much for your time, both attendees and my fellow panelists. It was a ton of fun as always chatting with you all. We will be back in a few weeks with another panel, I believe, on venture capital. So stay on the lookout for that. And hopefully everyone's staying cool and enjoying conferences if they are there. But I hope everyone has a good rest of their day.
Thanks, Jack.
Thanks.
Thanks, everyone.